Hi, my name is Brody. I'm the Clinic Director of the Curtin Tax Hospital. How can we assist you today?
Hi, my name is Riya and I'm here to get some tax advice. I've recently been thinking about starting my own business. My idea for it is a clothing boutique where I design and make the clothes myself. I'd like to get some information about the different business structures there are and what's the best option for me. I have about $85,000 saved up and I will be taking out a loan from the bank, so I'd like to know about the costs for each business structure as well.
It's nice to meet you, Riya. I recommend that you consider the sole trader structure for your business. A sole trader is best defined as an individual running a business where there is no legal distinction between the owner and the business entity. They owe unlimited liability to the debts of the business, but also enjoy 100% control and ownership of that business. Some tax implications of a sole trader are that they're not actually a taxable entity. Income is reported in your personal tax return along with your other income. You can also claim business deductions in your tax return, but only against your business income. Business losses may also be claimed as a deduction against all other income in your return, but only after passing the non-commercial loss tests. The purpose of these tests is to distinguish between hobby activities and business activities, as only losses from business activities are deductible. There are 4 areas of importance to consider when choosing an appropriate business structure. These reflect the advantages and the apparent disadvantages of that structure. The first area of importance is asset protection. Sole traders have minimal asset protection without the utilization of other structures or by taking advantage of insurance. As you and the business are one entity, personal and business assets are at risk in the event that you are sued or suffer bankruptcy. This risk can be mitigated by using a company structure to accommodate important assets, or by acquiring professional indemnity insurance to pay damages filed against you. The second area of importance is income tax minimization. As business income is reported in your own return, you pay tax at individual rates. This allows you to use a tax-free threshold of $18,200 to lessen your tax burden. You also enjoy a lower overall rate of tax, as tax brackets are used as opposed to a flat tax rate. This works as a great advantage for small businesses like yours, earning low to medium income. The third area of importance is CGT minimization. Running your small business as a sole trader allows for excellent capital gains tax minimization, thanks to combining small business concessions and the general CGT discount only available to individuals. On the disposal of an asset you use or is held for use in your business, you can receive up to a 75% discount to the recognised capital gains if you've held the asset for more than 12 months. And in the event that you want to change your structure to allow for expansion, or you want to invite a partner to help manage the business, you can use the small business restructure rollover relief to roll your assets into the new entity without having to pay any CGT on the CGT events resulting from the transfer. The fourth and final area of importance is ease of administration and costs. Accounting and tax agent fees are low as the structure lacks complexity. Setting up and winding up a sole trader business is the least onerous out of any other business structure and has virtually no cost. Setting up a sole trader only requires for an ABN registration and business name registration if you choose to have one. Winding up a sole trader is straightforward and involves following the regular procedure for the disposal of assets and trading stock, then cancelling your ABN and any other registrations you hold for the business.
So a sole trader would be a good option if I want to operate the business by myself, but what if I want to open the business along with my cousin? How would that change what business structure I can use? What would the advantages and disadvantages be of doing that? My cousin and I were thinking of equal ownership.
Hi Riya, so I've been told you'd like to know more about partnerships. So the law provides 2 definitions for partnerships. At common law, the law states that a partnership is where 2 individuals or groups come together with a view of making a profit. While under tax law, a partnership is where 2 or more individuals are recipients of joint statutory or ordinary income. Under tax law, there is no specific criteria on what makes a partnership. It is a question of fact. This means that individuals must showcase through their conduct an intention that a partnership is present. This can be showcased by holding a joint business bank account, being registered jointly under the business name, and receiving the net profits of the business. When comparing this business structure to the others, it is important to take into account the following: asset protection, tax implications, CGT, and administration costs. Partnerships have unlimited liability. This plays an important factor when considering asset protection. In a partnership, any asset that the partnership holds is earned according to the partnership shares. In cases where the partnership cannot meet their contractual obligations and a legal dispute arises, there may be a need for the partners to pay back the debts using their earned personal assets. This essentially means that the personal assets of the partners are unprotected. This is a key disadvantage for the partnership structure. However, you can decide to become an unlimited partnership. This allows you to only be liable for your share of the business and will leave your assets protected. However, you will lose your control of the daily operations of the business. Capital gains tax is not dealt in the context of partnerships. These will be derived to the partners according to their shares of the business. The CGT will then be dealt with like a sole trader. In the context of tax implications, partnerships are not taxed in their own right, as it is not a separate legal entity. Instead, each partner pays tax in their personal tax returns, where it would include the distributions of the net profits from the business. The net profits of the partnership can be reduced by deducting any expenses that the business has incurred. However, unlike a sole trader, partnerships are unable to deduct salary costs and superannuation given to the partners. Forming a partnership structure is very simple and cost efficient, as it requires few legal formalities and administration costs. This is a big advantage. Such costs would include registration, ongoing renewals, cost of accounting, and the partnership agreement. This can be moderate or costly depending on the complexity of it. To avoid misunderstandings and disputes, it is important to have a written agreement. The agreement should set out the contractual relationship between the partners and outline their responsibilities, distribution of income, and the guidelines for adding or withdrawing a member from the partnership. If a partnership fails to create an agreement, any disputes will be dealt with according to the Partnership Act of WA.
Hi Riya, so now I'm going to explain the company structure to you. So basically, company is a separate legal entity which is owned by shareholders or members and managed by directors. Moreover, the company has more complicated obligations than other structure because it has to comply with legal duties under the Corporations Act and must lodge the annual return with the ATO. So now I am going to provide the advantages and disadvantages of conducting your business in a company structure. Firstly, the ability to raise capital is an advantage. Companies commonly increase their capital via two types of finance, which are debt finance and equity finance. Debt finance are the money being lent to you from an external lender, such as banks, while equity finance are the money that is gathered from internal circle, which is mostly from your shareholders. Secondly, company pay lower tax rates. Company income tax is at 30% rate and it could be lower if you are a base rate entity. So it is ideal for company to reinvest in the business for this matter. And lastly, it is the limited liability, which means that company is its own legal entity and it separates the liability from the members. So members are not personally liable for any debts incurred by the company and they are safe from any legal actions taken against the company. So now I am going to discuss the disadvantages of running a company. To start, a company requires a huge budget to establish, maintain, and wind up. According to us, a company must pay registration fees, annual review fees, lodgement fees, and late fees, along with the publishing of an annual statements. The next one is double taxation, because company is treated as a legal entity separate from its members, and they have to pay taxes on their income. But when a company pays dividend to shareholders, those dividends bring income tax liability to the shareholders who receive them. And now I'm moving on to explore the important areas of company structure. First area of importance is asset protection. The owner of the company is not liable for any liability, breach of contract, or personal injury to a third party caused by the company, employees, or agents. Whether the company is liable or not, creditors are limited to pursuing only the company's asset to resolve the claim. Second area of importance is CGT minimization. Unfortunately, company is not entitled to any CGT discounts and have to pay 30% tax on any capital gains. The third one is ease of administration. Companies do not have a smooth administration process because they have many tax issues such as applying for TFN, registering for ABN and GST if the annual turnover is more than $75,000, and they have to pay superannuation contributions to qualified employees and directors. However, they can reduce amount of tax to be paid through the pay-as-you-go installments. And lastly is income tax minimizations. Company can claim deductions for any fringe benefit given to employees and superannuations payments.
I've also heard people mention about trusts, but I'm not sure about how they work. What if we would like to include our brothers, but they're all still minors?
I would like to introduce you to our next structure, the trust. The trust is one of the most used business structure in Australia. The trustee runs the business for the benefit of the beneficiaries of the trust. In order to form a trust, you also need the settler who set up the trust and name the beneficiaries and the trustees. Settlers could not be a beneficiary. Then he provides the property or assets for the trust. Then we also need the appointer and the guardians. Has an ultimate power over the trust, and he can appoint or remove trust. The examples of the trust are Bill and Melinda Gates Foundations and the Walton Enterprise LLCs. There are two main types of trust, decisionary and unit trust. Family trust is a type of decisionary trust common for small businesses in Australia. They're easier to set up, and the trustee decides who receives the benefits and how the payout is going to be. A unit trust is similar to the companies, as a trust property is divided into units, just like shares. In the case of the client, I would recommend the family trust structure. Some important features of a trust are that it needs to have its own tax file number and ABN to use it for business dealings. It may be liable to pay tax depending on the wording of its deeds and whether any income of the trust is distributed to its beneficiaries. The trust benefits will be calculated in the beneficiary individual tax returns. In a situation where the trust accumulates net trust income and does not distribute it, the trustee is assessed on that accumulated income at the highest individual tax rate. In the case of assets protection, you can use a trust as an advantage. Trust structure is perfect for protecting the assets from bankruptcy. An asset and a property of a trust belong to the trustee. The individual beneficiaries are not liable to pay the creditors. If there is a marriage breakdown event, the property within a family trust has higher chances of getting excluded from the settlement. This is the same for the family members with unwise spending habits, for example, gambling addicts. You can provide them benefits without giving them full control of the assets. Next area of importance is tax minimization. As the benefits of the trust are distributed back to the beneficiaries, they are taxed at their individual margin. Thus, this allows the trust income tax to be distributed among the members and lowering the overall tax paid. Because the individual tax beneficiaries can take advantage of the tax-free threshold, and by spreading out the payments, the tax rates are minimized. However, losses from the trust are not distributed and carry forward to the next financial year. Another tax advantage of trust is that it allows you to get a 50% discount on capital gains. Just like the income tax, the CGT is also distributed to the beneficiaries and they are taxed at individual rates. The disadvantage of a trust would be its complex structure. In order to set up a trust, you need a lawyer or accountant. The cost of setting up a trust is going to cost you more than a sole traders or partnership. Same as company structure, there are extensive regulations that apply to you. As the property and assets are held by the trustee, the beneficiaries have less power and are unable to claim the titles. This is all for the trust. Thank you.
Thank you so much for all the information and your time. Sole trader was definitely a very good option for me, but I'm leaning more towards partnership. I think this would be the best structure for me considering the many benefits of the structure. One of the biggest advantages I've understood is that forming a partnership is very simple and cost efficient, and it requires less legal formalities and administration costs. I also think operating the business as a partnership will allow both of us to bring different skill sets to the table, which might help in expanding the business even more. One of the biggest disadvantages of a partnership is the liability of the partners for the debts of the business is unlimited. This can be reduced by forming a limited partnership, which will make both of us only be liable for the amount of our investments. We can also obtain insurance to cover the most highest risk areas of the business. Well, thank you so much once again, and I'll come back to you if I require further assistance.